In accounting, we are going to provide information about the business organization to the stakeholders. For provide information, we have to prepare financial statement. Therefore, when business going to prepare financial statement, from the beginning, information should be collected by using source document, information about changes in resource of the business organization should be collected by using source document. After that, those information should be recorded in the primary books. After that, those should be recorded in the ledger account by using double entry system. Therefore, now I am going to discuss how to record information in the ledger account by using double entry system. At first one, think about ledger account as well as ledger. This is a ledger accounts. Ledger account is a T accounts. Date, description, amounts. And this is a debit side. And this is a credit side. Date, description, amounts. And date, description, amounts. Debit side, credit side. It can be prepared like this also. Ledger account is a T accounts. Debit side and credit side. Some information should be recorded debit side. Some information should be recorded credit side. Debit and credit methods. Double entry system. This is a ledger accounts. Now think about ledger. Ledger is a place which is include more ledger accounts. This is a ledger. General ledger, debtors ledger, as well as creditors ledger. Think about ledger account is a T accounts, but ledger is a place which is include more ledger accounts. It may be general ledger, it may be debtors ledger, it may be creditors ledger. Therefore, all the transaction and events happening in the business organization should be recorded in the ledger account by using double entry system, debit and credit methods. Some information should be recorded debit side, some information should be recorded credit side. Therefore, you have to know what kind of information should be recorded debit side and what kind of information should be recorded credit side. This is the theory. Basis for double entry system also accounting equation. This is accounting equation. Assets equal liability plus equity. And equity can be divided by two parts, capital and return earning. Therefore, assets equal liability plus capital plus return earning. Retained earning further can be divided by two parts, income and expense. Therefore, accounting equation equal assets equal liability plus capital plus income minus expense. Therefore, think about income plus value, expense minus value. This minus value take other side. Therefore, asset plus expense. Minus value became a plus value. Asset plus expense equal liability plus capital plus income. This is the basic for double entry system. Now, this is the theory. As a result of transactional events, if asset and liability increase, those should be recorded debit side. Think about this is the debit side. If asset and expense increase, should be recorded debit side. If asset and expense decrease, should be recorded credit side. This is a debit side and this is a credit side. And liability, capital, income. If those are increased as a result of transactional events, those should be recorded credit side. Liability, capital, and income. If those are increased, should be recorded credit side. If those are decreased, should be recorded debit side. This is the important part. All the things happening in the business organization can be categorized assets, liability, income, expense, as well as capital. Then think about theory. Asset and expense increase should be recorded debit side. If asset and expense decrease, should be recorded debit side, credit side. But liability, capital, and income, if those are increased, should be recorded credit side. If those are decreased, should be recorded debit side. This is the important part. Now see the example. Think about ledger account as well as ledger. Now we are going to discuss how to record. What kind of information should be recorded debit side and what kind of information should be recorded credit side. This is the thing keep in mind. Very important. This is a basis for double entry system. Right now, see the example. First one, recognize which element change. Example number one, rupees 7,500 cash was invested by owner as a capital. Think which element change? Cash received to the business, therefore it is effect for cash increase as well as capital increase. Think about cash is asset increase. If asset increase should be record debit side. And capital increase, if capital increase should be record credit side. Therefore cash account debit, capital account credit. This is a cash account debit and capital account credit. Here as a capital, here as a cash, name of other ledger accounts. Therefore, this is the way you have to record cash introduced by owner as a capital. Cash account debit. Cash increase, asset increase. If asset increase, cash account debit. And capital increase, therefore capital account credit. Debit and credit method, double entry system. Think about second transaction. 500,000 cash obtained by owner for personal use. That is a cash drawings. Think business point of view. Cash decrease. Cash is asset decrease. Therefore, cash account credit. And drawings effect for capital decrease. As a result of drawings, effect for capital decrease. Drawings increase, it is effect for capital decrease. Therefore, if capital decrease, it should be record debit side. You have to prepare separate ledger account for that as a drawings. Cash decrease, therefore cash account credit and drawings account debit. This is a cash drawings. And think about third transaction. 1,200 worth of goods obtained by owner for personal use. That is a stock drawings, goods drawings. It is not effect for cash. Now think about goods drawings. Drawings part of capital. As a result of drawings, capital decrease. If capital decrease, drawings account should be debit. And goods drawings not effect for cash, it is effect for purchase. As a result of good drawings, purchase decrease, expense decrease. Therefore, purchase account credit. If expense decrease, should be record credit side. Therefore, purchase account credit, drawings account debit. This is the way you have to record stock drawings. Drawings account debit, it is not effect for cash now. Goods drawings effect for purchase. Purchase, then drawings. Think about basic theory. If asset and expense increase should be record debit side. If asset and expense decrease, should be record credit side. This is the thing keep in mind. Liability, capital and income. If those are increase, should be record credit side. If those are decrease, should be record debit side. Now think about fourth transaction. 1,800 worth of goods damage stock. Damage stock is expense. Stock damage, goods damage. Therefore, it is effect for purchase. Therefore, damage stock, expense increase. Therefore, damage stock account debit. As a result of damage stock, purchase decrease. Purchase then damage. Therefore, purchase is expense decrease. Therefore, purchase account credit, damage stock account debit. Therefore, damage stock account debit side and purchase account credit. As a description, we have write name of other ledger accounts. Damage stock not effect for cash. Damage stock is expense. Damage, purchase. Therefore, purchase is expense. As a result of damage stock, purchase decrease. Therefore, damage stock account debit, purchase account credit. Next one, 5. 1,400 cash donation for flood affected family. Cash donation. Effect for cash decrease as well as donation is expense increase. That's the impact. Cash decrease, donation increase. Donation is expense increase. Therefore, donation account debit. Cash decrease. Cash is asset decrease. If asset decrease, cash account credit. Therefore, donation account debit. Cash account credit. Donation is expense. Cash donation. Therefore, expense increase. Cash decrease. Asset decrease. Donation account debit. Cash account credit. Next one also donation but not cash stock donation. Worth of stock donation. Therefore, donation is expense. It is given 2,000 worth of goods donated for flood affected family. This is a stock donation. Therefore, donation expense increase and stock purchase decrease. Goods donation effect for purchase decrease. Therefore, purchase is expense decrease. Therefore, purchase account credit. Donation is expense increase. Donation expense increase and goods donation effect for purchase decrease. Therefore, donation account debit, purchase account credit. Therefore, donation account debit as a purchase. Here description as a purchase and purchase account credit as a donation. Name of other accounts. Therefore, here description donation. Think about cash donation, donation account debit, cash account credit. But stock donation, donation account debit, purchase account credit. Donation is expense. Stock donation effect for purchase, cash donation effect for cash. Then seventh one, purchase goods 5,000 on cash, cash purchase. Cash decrease, purchase increase. Purchase is expense increase, therefore purchase account debit. As a result of cash purchase, cash decrease, asset decrease, therefore cash account credit. Purchase account debit, cash account credit. Therefore, you have to prepare purchase account debit as a cash account credit as a purchase. Then 8.1, credit purchase. As a result of credit purchase, value is not paid yet. It is not effect for cash accounts. Therefore, we have to pay. Those are called creditors. It is equal trade payable. Therefore, as a result of credit purchase, purchase expense increase. Therefore, purchase account debit. But value is not paid in cash. We have to pay. Those are called creditors. It is equal trade payable. That's a liability increase. Therefore, expense increase, liability increase. Purchase expense increase, purchase account debit. Creditor is a liability increase, creditors control account credit. It is equal trade payable. Therefore, purchase account debit, creditors control account credit. It is equal trade payable account also. Cash purchase, purchase account debit, cash account credit. But credit purchase, purchase account debit, creditors account credit. Next one, purchase return. Think about purchase if it has return. Therefore, if it has return, payable amount decrease, creditors decrease, liability decrease. Therefore, trade creditor, trade payable accounts, creditors account should be debit. Liability decrease, payable amount decrease, as well as purchase also decrease. Purchase return. If it has return, purchase expense decrease. Therefore, purchase accounts credit, creditors account debit. For purchase return, we have to prepare separate ledger account. As a result of purchase return, purchase decrease. Therefore, purchase return account credit, creditors control account debit. It is not effect for cash, creditors control account debit, purchase return account credit. The next one, cash rupees 5,600 paid for creditors to settlement and discount receipts 400. Think about cash paid, cash decrease, asset decrease, think about cash accounts. And discount received is income increase. And both are effect for creditors decrease. This one effect for cash decrease, this one effect for discount received increase, and both value effect for trade payable, creditors decrease. Therefore, creditors decrease by both value 6,000, liability decrease. Therefore, creditors account should be debit 6,000. And paid in cash, cash decrease only 5,600, asset decrease. Therefore, cash account credit. Discount received is income increase. If income increase, should be record credit side. Therefore, creditors debit, total value, cash account credit 5,600, discount received is income increase credit. Therefore, think about discount received, separate should be records. Creditors account debit, discount received account credit. As a result of discount received, think about net impact. creditor decrease, liability decrease, therefore creditors account debit as well as income increase. Discount received account credit as a creditor control accounts. Name of other ledger accounts. And cash paid amount, cash account credit, creditors control account debit. Cash paid amounts, paid in cash, that value also effect for cash decrease, therefore cash account credit, creditors account debit. Paid in cash 5,600, effect for cash decrease, asset decrease, cash account credit, creditors account debit. Think about as a result of cash paid and discount received, both value effect for creditor decrease, creditors account debit separately. Effect for creditor decrease and paid in cash, cash decrease, cash account credit, discount received account credit. This is a basic part. Think about double entry system. We are going to prepare financial statement. Therefore, from the beginning, information should be recorded by using double entry system in the ledger. This is the ledger accounts and this is a ledger. Ledger is a place which is include more ledger accounts. And this is the theory. Try to recognize assets, liability, income, expense, and equity. Then think about effect, increase or decrease. If asset and expense increase, those should be recorded debit side. If asset and expense decrease, those should be recorded credit side. First one, recognize which element change. Then think increase or decrease. Then apply this theory. If asset and expense increase, debit side. If asset and expense decrease, credit side. But liability, capital, income. Effect for income, liability and capital increase should be recorded credit side. If effect for liability, capital, income decrease should be recorded debit side. This is a double entry system.